Hi, and welcome to this YouTube video. My name is Sniper from Sniper Trading Mentorship. In this YouTube video, I will be teaching you all the concepts you need to know to get a better understanding of how the foreign exchange market works. So it doesn't really matter if you are a completely beginner or you have already been trading by your own and you have missed out a few really important things about trading. This video is going to explain everything you need to know to get a better understanding of how the foreign exchange market works. So first things first, the word Forex. The word Forex is the abbreviation of foreign exchange, but also many people abbreviate it as FX. I'm really sure you have seen it at many places. So this also means foreign exchange. So this means that there is an exchange between two different currencies. For instance, US dollars or euros. And there is going to be an abbreviation for these currencies, such as US dollars as USD and euros EUR. So whenever someone is exchanging money, let's say if you are traveling to Europe or traveling to England, you will be exchanging to a different currency. Okay, but most importantly, how this all works. I'm really sure you have been watching many movies on the stock exchange. I will be discussing the main aspects and differences of the foreign exchange market and the New York Stock Exchange. So let's get into it. Okay, so let's get into the foreign exchange market. The foreign exchange market has an immense difference between the New York Stock Exchange market. The foreign exchange market is mostly done online, so that's where the big profit is made. While on the other side, there are also exchanges, physical exchanges, when someone travels to a different country, let's say from the United States, a tourist visits England, he is exchanging US dollars to British pounds. In this case, the big money is traded through a brokerage online. So let's take a look at the difference between the foreign exchange market and the stock exchange. So the foreign exchange market has a $7 trillion daily trading volume, while the stock exchange market only has just over $50 billion, including the New York Stock Exchange, London Stock Exchange, and the Tokyo Stock Exchange. So the Forex market is open 24 hours a day, 5 days a week, because there are 4 trading sessions, while the stock exchange market is only open on business days and business hours, and it's occasionally closed on holidays, while the foreign exchange market is always open because there are 24 hours with overlapping markets containing the Sydney market open, the Tokyo market, London market, and then the New York market. So this is the reason why the foreign exchange market is open 24 hours a day, 5 times a week. Okay, so let's talk about the different type of currency pairs. So there are 3 different type of currencies. The majors, the minors, what we call sometimes the cross pair currencies, and then last but not least, the exotic currency pairs. Okay, so first thing first, the major currency pairs. The major currency pairs always include the US dollar. And then the major currency pairs are traded with the large economy, such as England, the pound dollar, or the US dollar Swiss franc, or the Australian dollar US dollar, or the euro US dollar. While the minor currency pairs include the Australian dollar and the Canadian dollar. So in this case, the minors never include the US dollar. So this is what we call miners. The Canadian dollar, Swiss franc. The euro, British pound. The New Zealand dollar and the Swiss franc. And also euro, Japanese yen. So with the miners, there are always going to be bigger spreads. 2 or even 3 times bigger spreads on the miners over the major currency pairs, because the major currency pairs have bigger liquidity due to the more people trade it and there's more money going through it. So that's why major currency pairs are going to have lower spreads, while the exotic currency pairs are going to have way bigger spreads due to the less liquidity traded in that currency pair. Because if less people and less money is going through a currency pair, in this case with the miners and then the exotics, there is going to be less liquidity, which means that less liquidity, higher spreads. If there's more liquidity, such as with the major currency pairs, where more money is going through that currency pair and it's more known amongst the people, there are going to be less smaller spreads in that given currency pair. So it's always beneficial if you're looking for lower spreads to trade on the major currency pairs. Okay, so for now, let's talk about the abbreviations of the currency pairs. So I'm really sure you wonder why we write the currency pairs abbreviate in an abbreviated way. So, for example, you see the US dollar as USD. The first 2 letters stands for the country, such as US, United States, and then the last letter will always stand for the currency pair for that given country. So in this case, US, United States, and the dollar. Or GBP, Great Britain, and P stands for pound. So these 2 were major currency pairs. Or we can be talking about some exotic currency pairs, such as the Hong Kong dollar is the abbreviation HKD, Hong Kong, and then the last letter is D for the dollar. Or the Japanese yen, JP for Japan, and then the Y stands for yen. So as you can see, it's made up from 3 different letters. The first 2 stands for the country, and then the last letter stands for the given currency. Okay, so another important thing, what I'm really sure you didn't know about the currency pairs, is that why do we write Euro USD and not USD Euro? So the simple answer for this is that this is how the brokers offer the symbol. Over the years, people got used to this, so Euro USD, and that's how it got popular amongst the people. So it's really important to not mix it, because if you write Euro USD, so 1 euro is equivalent to 1.10 US dollars. So in this case, the euro is 10% more stronger over the US dollars. So the other way around would be US dollars, euros. So in this case, it wouldn't be 1.10 because we say US dollars, euros. So in this case, 1 US dollar is equivalent to 0.90 euros. So 1 US dollar is weaker than the euros. So it's really important to not mix it, because we get a different value, as you can see over here on the chart. So also another important fact, that the base currency will always stand on the left side, such as the euro. And then the quote currency, which is the US dollar right now on the right side, is the quote currency. And what this means that the currency is always the value of 1, the base currency. And then the quote currency is the value of how many dollars we need to pay in order to get 1 euros. So here we need to pay 1.10 US dollars to get 1 euros. So the stronger currency, the base currency, is always on the left side. And then the weaker currency, which is in this case the US dollars, is the quote currency is always going to stand on the right side. So the same goes with the other currency pairs too. So for example, the cross pair currency with the GBP, Great Britain Pound, and the Japanese Yen. So if the price of the GBP and Japanese Yen is equivalent to 160, we have Great Britain Pounds as the base currency and the Japanese Yen as the quote currency. So we will need to pay 160 Japanese Yen to get 1 pound. So now I will tell you how you can make profit in the foreign exchange market. So I'm really sure that you know that in the stock market, when you have shares in a company and then the value is rising, your shares are being more valuable. So in the foreign exchange market, you can even make money in two different ways. When the exchange rate is rising in value, and also when the exchange rate is on a downfall. And I will tell you how you can do that. So for example, if you want to buy the Euro USD at $1.056 and the price goes up to 1.058, so the price is on the uptrend, on a bullish market, you make money. But if you are selling and the market has to go down in order for you to make money. So if you are buying Euro USD, you are betting on a stronger euro and a weaker dollar. But in this case, if you are selling Euro USD, you are betting on a weaker euro and a stronger dollar in this case. Even though the price changes might be very small, we are trading with enormous trading volumes. So even on a small price change, as you can see over here, we can make decent profits. And that's what we call leverage. But I will tell you more about the leverage in another video. So thank you for staying until the end. This was the first video on the beginner course guide. There will be other additional videos following up on the leverage, as I said before. So thank you for staying until the end, and until then, be safe.